Hello everyone, welcome to the 162nd episode of me learning how to trade in Forex. So in the last episode we were going through what is a demo account and why I use one. So basically a demo account allows you to practice trading, so whether you want to test the waters if you're a beginner trader, so understanding how trading works properly before setting up a live account, learning the basics, understanding market dynamics and get to grips with the trading platform without incurring any real world losses, or an intermediate trader where you're trying out new strategies, so you've got some trading experience but you want to test out new strategies in real market conditions, or try a different trading platform in general without risking your capital, so you're looking to explore, experiment and build your trading confidence. Or whether you're an intermediate or advanced trader, I want to expand into new markets. So perhaps you started with trading Forex and now you're looking to trade some indices, shares, futures or commodities. So you could use a demo account to test the environment on there. And then you could also use a demo account to improve your weakness. So you could see where you keep losing out on, and if there's a market where trades consistently performs well, you might decide to focus on that market in your live account, and then use the demo account to work on markets where your trades consistently underperform. Demo account benefits you wherever you are on a trading journey. And what other differences and similarities are there between demo and live accounts? So biggest contrast between a demo and live account is that you're trading virtual money, and there are a few other differences to be aware of too. So trades made through a demo account won't be subjected to margin call because you're not actually trading with live or real capital. You will also not be charged for chart packages on the demo accounts, and any updates made to the live trading platform might take a little while to reflect in your demo environment. So there's also some similarity between the two as well. So in both demo and live accounts, trades may be rejected if you have insufficient funds to open them, and trades will also not be closed if you don't have enough funds to cover margin and running losses. So you get a margin call if that happens in a live account. And then we looked at some of the functionalities to look for in a demo account. So if you're trying to trade in multiple markets, are you able to trade in multiple markets from that one demo account? So you might want to look for a demo account that gives you access to different asset classes that interest you. And you want to make sure that the demo trading account closely resembles a live account environment, because that's the whole point of using a demo account, to simulate real life live accounts environments. So it makes sense to them two to be similar. So also look for demo environments that enable you to set alerts on markets you want to keep an eye on, so you can react instantly to any price movements. Then we looked through how to open demo trading account on IG, and we went through the lesson summary. So we started off doing this as well. So demo trading account is your lab. Basically, we looked through the important basic terms that's used when referring to a demo account. So workspace, watch list, trading alerts, trading plan and hedging. And then we read through this little did you know bit. So now we're on to exploring what you can do with graphs and charts. So let's carry on where we left off at in the last video. So how can I use charts and graphs? Yeah, graphs and charts. Charts can help you interpret the behaviors of buyers and sellers to give you an indication of where the market could go next. Charts can help you to interpret the behaviors of buyers and sellers to give you an indication of where the market could go next. As you'll notice when you look at a chart, the market will usually move in one overall directional trend. There are three types of market trends: upwards, downwards and sideways trends. Yep, so three types of market trends: upward, downward and sideways. Some trading platforms, including ours, offer smart charts that enable you to analyze price performance across different time frames and create a deal immediately, direct from the charts. You can open, close, and edit positions in just a few clicks. There are several important principles to bear in mind when trading with charts. The first is that while they may form part of your technical analysis, they should never be used in isolation when making trading decisions. So charts should never be used in isolation when making a trading decision. Ensure you combine your chart analysis with fundamental analysis and refer to your trading plan before opening any positions. So, ensure you combine technical analysis with fundamental analysis. So remember, that's looking at like news and stuff like that. And refer to your trading plan before opening any any positions. Also remember that while trends and chart patterns could be indicative of future price movements, they're never guaranteed. Remember that chart patterns and trends don't guarantee future price movements. There are, however, certain chart patterns that traders may use as indicators when deciding to take a position. For example, the 3 white soldiers candlestick pattern might be used in determining a price reversal following a downtrend, while the ABCD trading pattern can be used in predicting future stock price swings. I think we went through all these before. It's also worth exploring different types of charts. For example, a Renko chart comprises bricks that show only significant price trends. You can find out more about the Renko charts and how to use them here. To use charts in your demo trading account, search and select the asset you're interested in trading and add it to your workspace. Select the specific details. For example, if you're working with Forex, choose the currency pair you wish to view, and you'll see a chart. It will be the default one. You can then use available indicators from Bollinger Bands to Relative Strength Index to analyze the chart. You can also use drawing tools to highlight key trends, patterns, and levels. When you're ready, place a trade in the deal ticket. Which trading strategy should I try? There are many different trading strategies you can use. The ones you choose to implement will depend on your personality, risk profile, interest, goals, and resources. So, the trading strategy you use will depend on your personality, risk profile, interests, goals, and resources. However, there are several popular strategies you may want to consider as you explore the possibilities your demo trading account offers you. In this lesson, we look at 3. News trading strategy. So, news trading strategy. Traders using this strategy base most of their trading decisions on news announcements because the financial markets usually react to these kind of developments. Traders using this strategy mostly base their trading decisions on news announcements, as the financial markets usually react to these kind of developments. Trading decisions are based on how the trader believes breaking news, economic reports, and company declarations may affect an asset's value. So, trading decisions are based on how the trader believes breaking news, economic reports and company declarations may affect an asset's value. May affect an asset's value. In the industry, there's a saying, buying the rumor, sell the news, which refers to traders opening position on speculation ahead of a news announcement that could affect an asset's price. Read more about how to trade the news. Yep. Swing trading strategy. So, swing trading strategy. Swing trading is a popular short-term focused trading style that centers on the goal of capturing a portion of a larger move. So, a short-term focused trading style which centers on the goal of capturing a portion of a larger move. Swing traders will take smaller but more frequent gains, cutting losses as quickly as possible. So swing traders will take smaller but more frequent gains, cutting losses as quickly as possible. Sounds like a scalper. Within the category of swing trading, you get trend trading and breakout trading. Two styles within swing trading. Trend trading, using technical indicators to identify the direction of market momentum. Swing trading strategies seek to capture a portion of this trend, taking advantage of the swing high or low. Read more about how to start trend trading. Right, so using technical indicators to identify the directions of market momentum. Swing trading strategies seek to capture a portion of this trend, taking advantage of the swing high or low. By taking advantage of the swing high or low. And then we've got breakout trading. Taking a position as early as possible within a given trend to try to capitalize on the market movement. So taking on a position as early as possible within a given trend to try to capitalize on the market movement. I think I remember doing something similar to this in one of the previous lessons we did, where basically trend trading comes in late after you confirm the trend is actually there. So it's more secure than breakout trading, where you just hop in as soon as you see a breakout happening. So yeah, I remember doing some of this I think. A market movement, capitalize on market movement. Swing traders will look to identify points at which the market is about to break out from the range in which it has been trading, typically when a support or resistance line is broken. So swing traders will look to identify points at which the market is about to break out from the range in which it has been trading. From the range represented by the support and resistance levels in which it has been trading. Position trading strategy. This is a strategy where the trader holds a position for a longer period of time, ignoring small price fluctuations and aiming to profit from the long-term upward trends. So a trader holds a position for a longer period of time, ignoring the small price fluctuations and aiming to profit from the long-term trend. Doesn't always have to be upward. I think you can sell for long-term as well, right? While there's more room for rewards, the inherent risk is also higher as position traders might ignore minor fluctuations that go on to become full trend reversals, which can result in significant losses. Position traders use a variety of tools, including fundamental analysis and market trends, to make trading decisions. Read more about position trading strategies. The inherent risk for this strategy is high as position traders might ignore minor price fluctuations which go on to become full trend reversals, which can result in significant losses. Position traders use a variety of tools, including fundamental analysis and market trends, to make trading decisions. Therefore, position traders use both fundamental analysis and technical analysis to make trading decisions. For more information on different trading strategies to test and markets to try, visit our webinar library. Okay, so lesson summary. A demo trading account is a good place to safely try out fresh trading strategies and to experiment with new ways of analyzing information and making trading decisions. Customizing your workspace and making use of charts and graphs can help you to identify market patterns and trends, which can assist in making trading decisions. While your trading strategy is a personal choice based on everything from your risk appetite to your resources, there are many popular approaches that are successfully used by other traders that you might find worth exploring. Yep. Understanding costs. Understanding costs. Understanding costs. Whoa, not 30. Whoa. Too soon. When you trade, there are several potential costs you need to be aware of. Because a demo account simulates a real trading environment, the costs are replicated too, to help you understand exactly what fees and expenses you would incur under real-world circumstances. In this lesson, we look at the main types of trading fees, costs and other critical financial considerations, and how these might differ between various products. So what are trading fees? Trading fees are the primary way in which brokers make money. They apply when you buy or sell an asset and are paid to the broker as a commission for helping to facilitate the trade through its platform. So, the primary way for brokers to make money, this is applied, this is taken from buying and selling an asset and are paid to the broker as a commission for helping to facilitate the trade through its trading platform. Trading fees change substantially from product to product, so they'll be different if you're trading Forex, options, shares, and so on. They also vary between brokers, so trading fees change between the asset being traded and also between different brokers. Fee models also differ. For example, some providers give a discount on charges for people trading particularly large volumes. Some charge a flat fee to initiate a trade regardless of the size, while others charge a commission per unit traded. Some use a combination of a base fee plus a fee per unit. It's important to understand trading fees because they affect the amount of money you end up with. Fee models also differ, so i.e. some brokers give a discount when trading large volumes, whereas some brokers charge a flat fee to initiate a trade. So trading fees affect the amount of money you end up with. Types of trading fees and costs. Let's look at some of the most common types of fees and costs you're likely to encounter as you explore your demo trading account. Spread. In trading, spread is the difference between the buy offer and the sell bid prices quoted for any given asset. So spread, the spread is the difference between the buy, so offer, and sell bid prices quoted for any given asset. And you most often see this in spread betting and contracts for differences trading, except when trading share CFDs, where we charge a commission instead. This is the way many brokers quote their prices. It simply means that what you'll pay to buy an asset will always be slightly higher than that of the underlying market, while the price to sell will always be slightly below it. So you can calculate the spread by deducting the bid from the offer. When you're trading, you're hoping that the market value will move beyond the price of the spread so that your trade can be closed in profit. So when you're trading, you're hoping that the market value will move beyond the price of the spread so that your trade can be closed in profit. If the price doesn't go further than the cost of the spread, you risk closing at a loss, even if the market moves in a direction you predicted. So if the price doesn't go further than the spread, you risk closing a trade at a loss, even if the market moves in your favor. You can work out your total spread cost by multiplying the monetary value of a position per point by the spreads. It's important to bear in mind that CFD position sizes are based on contracts, which means the calculation involves an extra step. For example, say you purchase one contract on an index, where that one contract is valued at £10 per point, and the spread between the bid and ask price is 1 point. Your total spread cost would be one contract times £10 per point, times our 1 point spreads, which is £10. So did you know in demo live trading accounts, you can see the spread reflected in our deal ticket. So that plus that should be that, or that minus that should be that. Yep. So deal order alert info, sell price, buy price, size euro per point, minimum 0.56, price level expiry good till cancelled, stop loss normal, points away minimum 2 points away, limit number of points away, net off, force open. Okay, commissions. These are charged when trading shares using a CFD account, so contract differences account, and are calculated as a percentage of the transaction value for most markets, with minimum charges or a cents per share. So charged when trading shares using contract for differences using contract differences account, calculated as a percentage of the transaction value for most markets, with minimum charges or a cents per share. For example, say you want to trade shares on a company on the FTSE 350. The commission you pay on each side of the trade, in other words open and close, is 0.10%, with a minimum charge of £10 online. If you traded over the phone, the minimum would increase to £15. Similarly, if you traded US shares, you pay a 2 cent per share commission each side of the trade, with the minimum value being $15 online or $25 over the phone. You can learn more about our share CFD trading costs here. Right. Overnight funding. If you hold a short-term trade and you decide to keep it open overnight, you'll be charged a daily interest fee. So if you hold a position short-term trade and you decide to keep it open overnight, you'll be charged a daily interest fee. For example, this charge applies to daily funded bets, and cash contract for differences positions. This is because these products are leveraged, which means you're effectively being lent the money required to open a trade. To keep your positions open after 10 PM UK time, it needs to be funded overnight, and this means an interest adjustment will be made to your account to reflect that cost. So it's important to understand that overnight funding fees will be shown as separate charges on your accounts. So overnight funding fees will be shown as separate charges on your accounts and not reflected in your running profit slash loss, usually delivered via an email statement. Right, okay, so send you an email for it, okay? You need to take these charges into account when calculating your actual profit. So you need to take these charges into account when calculating your actual profit. It's also critical to note that overnight funding is calculated differently for indices, shares, ETFs, Forex, commodities and other markets. So overnight funding is calculated differently for each asset. Did you know, as well as understanding any trading fees that may affect your ultimate profit or loss, you also need to keep an eye on adjustments to your accounts. In an investment account, this might simply include fees and charges, but if you're trading, it may be more complex, as this can include additional costs such as if you were to trigger a guaranteed stop. Gross exposure. Something that many beginner traders struggle to understand is the potential impact of their gross exposure on their profit or loss. Financial exposure is simply the amount of money you stand to lose when you trade or invest, also known as risk. Risk is or financial exposure is the amount of money you stand to lose when you trade or invest. When you invest in an asset, your exposure is limited to the amount you pay for it. For example, if you buy 100 shares in ACME company at £1 per share and they lose all their value, the maximum amount you stand to lose is 100. However, when you trade using leverage, you use margin deposit to open your position. While this reduces the initial outlay, amplifies your exposure and magnifies both profits and losses. For example, if your margin is 20% on ACME company shares on £1,000 trade, then you'd only need to pay £200 to open the trade. Your exposure, however, is the full amount of the trade, £1,000. Your gross exposure is your total exposure to the market, including long and short positions and use of leverage. So, your gross exposure is your total exposure to the market. In the next lesson, we'll look at some of the important metrics to consider when evaluating your trading performance, as well as some different ways to use a demo account to experiment with different products. So when you invest in an asset, your exposure is limited to the amount of money you paid for it. However, when we trade using leverage, when you trade using leverage, your exposure is amplified. Your exposure is amplified. Yep. So your gross exposure is total exposure to the market, including long and short positions and use of leverage. So, which includes long and short positions and also use of leverage. In the next lesson, we'll look at some of the important metrics to consider when evaluating your trading performance, as well as some different ways to use a demo account when experimenting with different products. Right, so lesson summary. When you trade, there are several potential costs you need to be aware of, including fees and commissions, specific product costs, and overnight funding charges. Aside from fees and costs, you also need to take any adjustments into account when calculating your total return. So, aside from fees and costs, you need to take account of any adjustments such as guaranteed stops, aside from fees and costs, you need to take into account any adjustments such as guaranteed stops when calculating your total return. When you're trading leveraged products such as spread bets or CFDs, it's important to understand your gross exposure, which can be magnified far beyond your initial deposit. So, keeping track of your trading performance. Keeping track of your performance, of your trading performance. Let's just do some reading before we close off this video. So, keeping track of your trading performance is important for two major reasons. It ensures you know how much money you're making or losing, and it helps you to improve your trades over time. So, keeping track of your performance you know how much money you're making or losing. You know how much money you're making or losing, and it helps you to improve your trades over time. And it helps you to improve your trades over time. In this lesson, we'll look at how to track performance, some key metrics, as well as ways to experiment with your demo trading account. Just a quick one. I forgot to add something for the spread. So basically what I missed out was, where is this? So calculate spread by deducting the bid from the offer, which I kind of said it here, but I'm going to add it in anyway. So spread is calculated from deducting the bid from the offer. Okay. And then we also got work out your total spread cost by multiplying monetary value of your position per point by the spread. So you can calculate your total spread cost by multiplying the monetary value of your position per point by the spread. Monetary value position per point by the spread. It's important to bear in mind that CFD position sizes are based on contracts, which means the calculation involves an extra step. So CFD positions are based on contracts, so they involve an extra step, which might be the number of contracts, maybe. So yeah, I think that's all I have to add for the spreads. So yeah, that's all. Quick one from me. Thank you. Goodbye.